Listen carefully because what I'm about to tell you could be the difference between a comfortable retirement and working until you die. The traditional retirement playbook is dead. The old rules about stocks, bonds, and hoping Social Security will save you are not just outdated, they're dangerous in today's economic environment. I've been helping people build wealth for over 4 decades, and I've never seen a more challenging retirement landscape than what we're facing right now. Inflation is destroying purchasing power, interest rates are creating havoc in bond markets, Social Security is heading toward insolvency, and most people's retirement savings are completely inadequate for what's coming. But here's what separates successful retirees from everyone else who's going to struggle. They don't rely on hope, they don't count on government programs, they build retirement portfolios around 5 specific types of assets that generate income, preserve purchasing power, and grow wealth even during economic chaos. These aren't exotic investments that only billionaires can access. These are assets that anyone can acquire if they understand what to look for and how to structure their portfolios correctly. But you have to start building these positions now, before retirement, because once you're retired and living on fixed income, it becomes much harder to recover from financial mistakes. If you're serious about retiring comfortably instead of becoming a financial casualty of economic change, hit that subscribe button right now. Because what I'm going to reveal today could save your retirement and ensure you maintain your lifestyle, regardless of what happens to the economy over the next 20 years. The first asset that's absolutely essential for any serious retirement portfolio is dividend growth stocks, but not just any dividend stocks. I'm talking about companies that have raised their dividends consistently for at least 25 years, including through multiple recessions and economic cycles. These are called dividend aristocrats, and they're the foundation of retirement income that actually grows over time. Here's why this is so critical. Most retirees make the fatal mistake of chasing high current yields from companies or bonds that can't sustain those payments. They buy stocks yielding 6, 7, 8% without understanding that unsustainable high yields are usually a warning sign of financial trouble. Dividend aristocrats take the opposite approach. They start with lower current yields, typically 2 to 4%, but they raise those dividends every single year. A stock that starts yielding 3% and grows its dividend by 7% annually will be yielding over 6% on your original investment after 10 years. That's the power of compound dividend growth. But the real magic happens over 20 or 30-year retirement periods. That same 3% yielding stock growing dividends at 7% annually will be yielding over 12% on your original investment after 20 years. Your annual dividend income will be quadrupling while you sleep, and that's before considering any stock price appreciation. This is how you build retirement income that not only keeps up with inflation, but actually outpaces it significantly. While retirees who chased high current yields are watching their income stagnate or decline, dividend growth investors are receiving larger checks every year. But you have to choose these companies carefully. Not every company that pays dividends is a good dividend growth investment. You need companies with sustainable competitive advantages, strong cash flow generation, conservative payout ratios, and long track records of prioritizing shareholders through dividend payments. I focus on companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, Microsoft, Apple. These are businesses with products and services that people need regardless of economic conditions. They have pricing power that allows them to pass increased costs on to customers. They generate cash flows that grow consistently over time. The key is building a diversified portfolio of 20 to 30 dividend aristocrats across different sectors. This gives you exposure to healthcare, consumer staples, technology, industrials, utilities, all sectors that provide essential products and services. When one sector faces temporary challenges, the others continue generating reliable income. The second asset that's absolutely critical for retirement success is real estate investment trusts. But again, not just any REITs. You need REITs that own essential income-producing real estate that will maintain its value and rental income regardless of economic conditions. I'm talking about REITs that own healthcare facilities, data centers, cell phone towers, warehouses, storage facilities, multifamily residential properties in growing markets. These are properties that generate steady rental income from tenants who can't easily relocate or reduce their space requirements. Healthcare REITs are particularly attractive for retirees because healthcare demand is recession-proof and actually increases as the population ages. Data center and cell tower REITs benefit from the unstoppable growth of digital technology and internet usage. Warehouse REITs benefit from the continued growth of e-commerce and global trade. The beauty of investing in REITs for retirement income is that you get professional real estate management without the headaches of being a landlord. You don't have to deal with tenant problems, maintenance issues, property taxes, or any of the operational complexities of direct real estate ownership. Quality REITs typically yield 4 to 6% and grow their distributions over time as rental rates increase and occupancy improves. This provides both current income and inflation protection since real estate values and rents tend to rise with inflation over long periods. But you have to be selective about which REITs you choose. Avoid REITs that own retail properties, office buildings, or hotels. These properties face structural challenges from changing work patterns, online shopping, and economic volatility that make them unsuitable for retirement income portfolios. The third asset that every retirement portfolio needs is Treasury inflation-protected securities known as TIPS. These are government bonds that adjust their principal value based on inflation, ensuring that your purchasing power is preserved regardless of how much prices rise over time. Here's why TIPS are essential for retirees. Traditional bonds lose value during inflationary periods because their fixed interest payments become worth less in real purchasing power terms. TIPS eliminate this risk by adjusting both the principal value and interest payments for inflation. TIPS serve as the defensive anchor of your retirement portfolio. While your growth assets like dividend stocks and REITs are working to increase your wealth over time, TIPS ensure that the core of your portfolio maintains its purchasing power no matter what happens to the currency or inflation rates. The key is laddering TIPS with different maturity dates so that you have bonds maturing regularly throughout your retirement. This provides predictable cash flows and the opportunity to reinvest maturing bonds at potentially higher interest rates if rates rise over time. I recommend allocating 20 to 30% of a retirement portfolio to TIPS, depending on your risk tolerance and other income sources. This provides a stable foundation that protects against the biggest risk retirees face, which is the erosion of purchasing power through inflation. The fourth asset that's absolutely essential for retirement security in 2026 is physical precious metals, specifically gold and silver. Now, before you dismiss this as old-fashioned thinking, let me explain why precious metals are more important today than they've been in decades and why every retiree needs some exposure to protect their wealth. Here's what most financial advisors won't tell you about precious metals in retirement portfolios. They're not just investments, they're insurance against currency debasement, government fiscal irresponsibility, and systemic financial breakdown. When paper currencies lose value, when governments can't service their debts, when financial systems face crisis, precious metals maintain their purchasing power. The fiscal situation facing developed countries is unprecedented in modern history. Government debt levels are unsustainable, central banks are creating money out of thin air, and politicians are making spending promises that can't be kept without destroying the currency. Precious metals are the only assets that have preserved wealth through every currency crisis in human history. But precious metals serve another critical function for retirees that most people don't understand. They provide liquidity and optionality during crisis periods when other assets might be difficult to sell or access. Physical gold and silver can be converted to cash anywhere in the world, regardless of banking system problems or market closures. I recommend allocating 5 to 10% of a retirement portfolio to physical precious metals, stored in secure facilities where you can access them if needed. This isn't a speculation on precious metal prices going higher, although they probably will. This is insurance against catastrophic loss of purchasing power in paper assets. The key is buying physical metals, not paper substitutes like ETFs or certificates. During a real crisis, you want to own actual metal that you can hold in your hand, not promises from financial institutions that might not be able to honor their obligations. Focus on recognized forms like American gold eagles, Canadian gold maple leafs, or gold bars from accredited refiners. For silver, stick to American Silver Eagles, Canadian Silver Maple Leafs, or silver bars from reputable sources. Avoid collectible coins or exotic forms that might be difficult to sell when you need liquidity. The fifth and final asset that every retirement portfolio must have is international dividend-paying stocks, particularly companies based in countries with stronger fiscal positions than the United States. This provides geographic diversification and protection against domestic economic problems or currency debasement. Here's why international diversification is more important now than ever before. The United States faces unprecedented challenges, including unsustainable debt levels, political polarization, regulatory overreach, and demographic changes that threaten long-term economic growth. Retirees who keep all their assets in U.S.-denominated investments are taking enormous concentration risk. Countries like Switzerland, Norway, Singapore, and Australia have much stronger fiscal positions, lower debt levels, and more sustainable economic policies than the United States. Companies based in these countries often provide better dividend yields and more conservative management than their U.S. counterparts. International dividend stocks also provide currency diversification, which is crucial for protecting purchasing power over long retirement periods. If the U.S. dollar weakens significantly, which many economists predict, assets denominated in stronger currencies will maintain or increase their value in dollar terms. But you have to be selective about international investments. Avoid countries with weak fiscal positions, high debt levels, or unstable political systems. Focus on developed markets with strong rule of law, conservative economic policies, and currencies that are likely to strengthen relative to the dollar over time. I recommend allocating 15 to 20% of a retirement portfolio to international dividend-paying stocks, focusing on utilities, consumer staples, healthcare companies, and telecommunications firms that provide essential services and have strong competitive positions in their home markets. Now let me show you how to structure these 5 asset categories into a complete retirement portfolio that generates income, preserves purchasing power, and grows wealth over time. This isn't about taking big risks or chasing high returns. This is about building a fortress that protects your financial future regardless of what economic challenges develop. Here's my recommended allocation for a conservative retirement portfolio. 40% dividend aristocrats, providing the growth engine and primary source of rising income. 25% quality REITs, providing real asset exposure and additional income. 20% tips, providing inflation protection and stability. 10% physical precious metals, providing crisis insurance and purchasing power protection. 5% international dividend stocks, providing geographic and currency diversification. But allocation is just the beginning. The key to retirement portfolio success is systematic rebalancing and strategic adjustments based on changing economic conditions. This means taking profits from assets that have performed well and adding to assets that have become attractively valued. Rebalancing forces you to sell high and buy low systematically, which improves long-term returns and reduces portfolio volatility. Most retirees make the mistake of letting their portfolios drift with market movements, which can result in dangerous concentrations in overvalued assets. I recommend rebalancing quarterly or whenever any asset category moves more than 5 percentage points away from its target allocation. This disciplined approach ensures that your portfolio maintains its intended risk and return characteristics throughout changing market conditions. But rebalancing isn't just about maintaining target allocations. It's also about making strategic adjustments based on economic cycles and market valuations. When dividend stocks become expensive, you might increase your tips allocation temporarily. When REITs are cheap, you might reduce other categories to take advantage of the opportunity. The key is having a systematic process that removes emotions from investment decisions. Retirement portfolios get destroyed by panic selling during market declines and greed buying during market peaks. Systematic rebalancing prevents both mistakes by forcing you to act contrary to market sentiment. Another critical element of retirement portfolio management is tax optimization. Different asset categories have different tax characteristics, and smart retirees structure their holdings to minimize tax drag on their returns. This can add significant value over long retirement periods. Dividend aristocrats and REITs are typically held in taxable accounts because their dividends qualify for favorable tax treatment. TIPS are best held in tax-advantaged accounts because their inflation adjustments are taxable even though you don't receive the cash until maturity. Precious metals are held outside the traditional financial system and don't generate taxable income until sold. International stocks present more complex tax considerations because of foreign tax treaties and currency fluctuations. Work with a qualified tax advisor to ensure you're structuring international holdings in the most tax-efficient manner possible. But tax optimization shouldn't drive asset allocation decisions. The primary goal is building a portfolio that generates adequate income and preserves purchasing power. Tax efficiency is a secondary consideration that can enhance returns but shouldn't compromise the fundamental strategy. The most important element of retirement portfolio success is starting early and staying disciplined. These 5 asset categories work best when you have years or decades to build meaningful positions and let compound returns work in your favor. The earlier you start implementing this strategy, the more secure your retirement will be. Most people wait too long to start building serious retirement portfolios. They spend their 40s and 50s focused on accumulating assets without thinking strategically about how those assets will generate income during retirement. Then they reach their 60s and realize their portfolios aren't structured for income generation and capital preservation. Now let me show you exactly how to implement this strategy regardless of your current age or financial situation. Because knowing what assets to own is worthless if you don't have a practical plan for acquiring them systematically over time. Most people fail at retirement planning not because they don't understand the concepts, but because they don't execute consistently. If you're in your 30s or 40s, you have the enormous advantage of time, which is the most powerful force in wealth building. Start with the growth components first. Focus on building a substantial position in dividend aristocrats through systematic monthly investing. Even if you can only invest $500 or $1,000 per month, starting early allows compound growth to work miracles. Here's how the mathematics work in your favor. If you invest $1,000 per month in dividend aristocrats, earning an average of 10% annually, you'll have over $2 million after 30 years. That portfolio will be generating over $160,000 annually in dividend income, and those dividends will continue growing every year. But don't neglect the other asset categories just because you have time. Start building small positions in REITs, TIPS, and precious metals while you're young. This accomplishes 2 important objectives. It forces you to learn about these asset classes while you have time to make mistakes and recover, and it establishes the discipline of diversified investing that will serve you well throughout your career. If you're in your 50s, you're entering the critical wealth-building decade where your earning power is typically at its peak and your expenses may be declining as children become independent. This is when you need to accelerate your retirement savings dramatically and optimize your asset allocation for the transition to retirement. Focus on maximizing contributions to tax-advantaged accounts like 401k plans and IRAs. Use taxable accounts to build positions in assets that benefit from favorable tax treatment like dividend stocks and REITs. Consider Roth conversions to reduce future tax obligations on required minimum distributions. Most importantly, start stress testing your retirement plan with realistic assumptions about inflation, healthcare costs, and market volatility. Too many people in their 50s are cruising toward retirement with completely unrealistic expectations about what their lifestyle will cost and how much income their assets will generate. If you're in your 60s or already retired, your focus shifts from accumulation to income optimization and capital preservation. This is when having the right asset mix becomes absolutely critical because you have limited ability to recover from major portfolio losses. The biggest mistake retirees make is being too conservative with their asset allocation. They move everything into bonds and cash because they think it's safer, but this actually exposes them to the biggest risk of all, which is purchasing power erosion through inflation. A retirement that lasts 20 or 30 years will see significant inflation, and overly conservative portfolios can't keep up. My 5-asset strategy provides the perfect balance for retirees. The dividend aristocrats and REITs provide growth and inflation protection. The TIPS provide stability and guaranteed purchasing power preservation. The precious metals provide crisis insurance. The international stocks provide diversification and currency protection. But implementation for retirees requires careful attention to withdrawal strategies and sequence of returns risk. The order in which you sell assets and the timing of market volatility relative to your withdrawals can dramatically impact how long your portfolio lasts. Here's my recommended withdrawal strategy for retirees using this 5-asset approach. Start by living off the dividends and distributions from your dividend stocks and REITs. These provide 4 to 6% yields, which should cover most retirees' basic living expenses without touching principal. Use TIPS maturities and precious metal sales to fund extraordinary expenses like major healthcare costs, home repairs, or travel. This preserves your growth assets for as long as possible and ensures you're not forced to sell dividend stocks or REITs during market downturns. Only sell shares of dividend aristocrats or REITs when absolutely necessary, and when you do sell, focus on your largest positions or assets that have appreciated significantly. This maintains diversification and forces you to take profits from your best performing investments. The international component should be treated as a long-term strategic holding unless currency movements create compelling rebalancing opportunities. Currency fluctuations can create significant short-term volatility, but over long periods, strong currency exposure provides valuable purchasing power protection. Now let me address the biggest psychological barriers that prevent people from implementing this strategy successfully. The first barrier is complexity bias. People think that successful investing requires complex strategies that only professionals can understand. This leads them to either avoid investing altogether or to chase complicated products that benefit financial advisors more than investors. The 5-asset strategy I've outlined is intentionally simple. These are asset classes that anyone can understand and implement through low-cost index funds, individual stock purchases, and direct ownership of physical assets. Simplicity is a feature, not a bug. The most successful long-term investors use simple strategies executed consistently over many years. The second barrier is recency bias. People assume that whatever has happened recently in markets will continue happening in the future. This leads to chasing last year's best-performing assets and avoiding assets that have temporarily underperformed. Both behaviors destroy long-term wealth. The 5-asset strategy protects against recency bias by maintaining consistent allocations regardless of short-term performance differences. Sometimes dividend stocks will outperform, sometimes REITs will lead, sometimes precious metals will be the star. The key is owning all 5 categories so you participate in whatever performs well while avoiding the impossible task of predicting which will perform best. The third barrier is perfectionism paralysis. People wait for the perfect time to start investing, the perfect asset allocation, the perfect market conditions. This perfectionism prevents them from ever actually implementing any strategy because perfect conditions never exist. The reality is that starting with an imperfect strategy today is infinitely better than waiting for the perfect strategy tomorrow. Markets reward time in the market, not timing the market. The compounding benefits of starting early far outweigh any minor optimization benefits from waiting for better conditions. The fourth barrier is fear of making mistakes. People are so afraid of losing money that they make the biggest mistake of all, which is not investing enough in growth assets to build real wealth. This fear often increases with age, precisely when people can least afford to be overly conservative. The 5-asset strategy addresses this fear by providing multiple layers of protection. Even if one asset category performs poorly, the others provide ballast and continue generating income. The diversification reduces portfolio volatility while maintaining growth potential. Here's what you need to understand about the urgency of implementing this strategy. The economic challenges facing retirees are unprecedented, and they're getting worse every year. Social Security benefits are being reduced through means testing and taxation. Healthcare costs are exploding faster than general inflation. Traditional pensions have virtually disappeared. At the same time, life expectancies are increasing, which means retirement portfolios need to last longer than ever before. A healthy 65-year-old today has a reasonable chance of living to 95 or beyond. That's a 30-year retirement that needs to provide consistent income while preserving purchasing power through multiple economic cycles. The traditional retirement advice of holding 60% stocks and 40% bonds is completely inadequate for this challenge. Bond yields are too low to provide meaningful income, and they provide no protection against inflation. Stock market valuations are so high that future returns are likely to be much lower than historical averages. My 5-asset strategy addresses these challenges by focusing on income-producing assets that grow their distributions over time, real assets that maintain value during inflation, and diversification across geographies and currencies. This approach has worked through multiple economic cycles and will continue working regardless of future economic challenges. But you have to start implementing it now. Every month you delay is a month of potential compound growth that you'll never recover. Every year you wait makes it harder to build the portfolio size needed to generate adequate retirement income. If this video has convinced you that traditional retirement planning is inadequate and that you need a more sophisticated strategy, then take action immediately. Start by subscribing to this channel and hitting the notification bell so you don't miss updates on market conditions and implementation strategies. Share this video with anyone approaching retirement or concerned about their financial future. Leave a comment below and tell me which of these 5 assets you're going to focus on first and what percentage of your portfolio you plan to allocate to each category. Remember, retirement isn't about reaching a certain age and stopping work. Retirement is about achieving financial independence, where your assets generate enough income to support your lifestyle without depending on employment income. The 5-asset strategy gives you the roadmap to achieve that independence regardless of economic conditions. The choice is yours. You can follow traditional retirement advice and hope that somehow the same strategies that have failed previous generations will work for you. Or you can implement a strategy designed specifically for the economic realities of the 21st century. I know which choice I'd make. The question is, what choice are you going to make?